You think you know how Starbucks makes money? You walk up, you pay $6 for a cup of milk, ice, and a couple shots of espresso. You assume the markup is obscene. Beans cost pennies. Cup costs pennies. The rest is pure profit, right? Classic retail robbery. Hiding behind a green apron. Here's the number. That should stop you cold. Starbucks. Net profit margin, what actually survives after every single expense, sits at 3.89% out. Of every $100 you hand over at the register, the company keeps less than 4. That's not a typo. A company built on a product with roughly 70% margin per cup is somehow only walking away with 4 cents on the dollar company-wide. So where does the other 66 cents go? Why has this company, with 21,000 plus locations you can practically feel in your bones from 3 blocks away, just posted 6 straight quarters of falling sales in its home market? And why did it hand its new CEO a pay package that touched 9 figures in the exact same year customers started calling it too expensive? Something doesn't add up. Let's take it apart. Picture the drink in your hand, 16 ounces. Maybe $1 in coffee, milk, cup, and lid. You paid $5.25, run that math, and you get a gross margin north of 65%. Some insiders peg brewed coffee even higher, north of 80%. That's the number that built the myth. Starbucks prints money on every single cup. Here's the first crack, that 65–80% only survives the walk from the espresso machine to the register. It hasn't paid rent yet. It hasn't paid the barista. It hasn't paid for the AC, the delivery trucks, the corporate office, or the marketing budget for the next seasonal drink. By the time all of that gets subtracted, the number that was 70 cents on the dollar shrinks down to under 4. Something is eating almost everything in between. And it's not what you'd guess. The obvious next theory. It's rent. It's labor. Big stores in expensive cities. Thousands of baristas. Of course, the margin gets crushed by overhead. Case closed. Except that story doesn't explain the timing. Same-store sales. The number that measures how existing stores are performing. Not new ones opening. Fell for 6 consecutive quarters through 2024 and 2025. The stock dropped. The chain went from record year after record year to preemptively warning Wall Street about bad news before earnings day. If overhead alone explained the squeeze, that squeeze would be constant, predictable, boring. It isn't. Something changed. Something the company itself built went wrong. Everyone assumes the growth engine is simple. Sell more cups, faster, to more people. That's why Starbucks spent a decade pushing you toward the app. Order ahead. Skip the line. Frictionless caffeine. It worked. For a while. Mobile and delivery orders soared. Digital ordering became the fastest growing part of the business. Then destroy that theory in real time. The CEO who took over in 2024 said it himself. The company had veered too much into mobile orders, and it took a lot of the soul out of the brand. Translation, the thing built to drive growth was quietly the thing breaking the store. Baristas buried under a wall of mobile tickets while the person standing at the counter waited 12 minutes for a drink that used to take 3. Customers stopped lingering. They stopped coming back as often. The convenience engine cannibalized the experience it was supposed to enhance. So if selling more cups faster isn't the real profit engine, and it clearly stopped working, what actually is? Look past the espresso machine. Look at the small rack of gift cards by the register, the one you've walked past 1,000 times without a second thought. At any given moment, Starbucks is sitting on roughly $185 billion in stored value, money. Customers have already loaded onto cards and into the app. For coffee they haven't ordered yet. Think about what that actually is. You hand Starbucks $25, they don't give you a product. They give you a promise. And that $20 sits in their account, earning them interest, funding operations for days, weeks, sometimes years, before you ever redeem a single dollar of it. Starbucks is holding more in customer prepayments than thousands of small community banks hold in deposits. People call it, only half-jokingly, the Bank of Starbucks. Now here's the twist that turns interesting into brilliant. Some of that money never gets spent at all. Cards get lost, forgotten in a drawer. Left with $6.40, nobody bothers redeeming. That's called breakage, and in a single recent year, it handed Starbucks over $200 million in pure, uncontested revenue. Money customers gave them for a product they never delivered. Layer one more piece on top. Thousands of Starbucks locations aren't even run by Starbucks. They're licensed, inside airports, grocery stores, university campuses, operated by someone else's staff, someone else's rent, someone else's labor headaches. Starbucks just collects a royalty and ships the beans, so the coffee was never the business. The coffee is the excuse to get you to preload cash, download an app, and hand a fraction of your operational risk to someone else entirely. Add up the pieces and a different company starts to appear. A prepaid financial network holding billions in float. A royalty business collecting fees from other people's real estate. A loyalty platform mining purchase data to time your next push notification. Somewhere in the middle of all that sits a cup of coffee, almost as an afterthought. Why do you preload $25 onto an app for a company you'll see again tomorrow anyway? Because the moment you load it, your brain stops experiencing it as spending. It's already gone. Every purchase afterward feels free. That's the entire trick behind stars, badges, seasonal drink drops, and the mild sense of a countdown every autumn when the pumpkin spice latte reappears like clockwork. Think about it. The seasonal drink isn't really about pumpkin. It's about scarcity with a deadline attached. A reason to show up this week, not whenever you feel like it. Because it disappears in November. And the third place branding, home, work, Starbucks, wasn't just marketing copy. It was a design decision. Comfortable chairs. Soft lighting. Slow enough pacing that you'd sit, open a laptop, order a second drink an hour later. That experience is what actually justified the $6 price tag in customers' minds. Not the coffee. The permission to occupy a chair for 2 hours and call it productive. Strip that experience away. Replace it with a wall of mobile order cups and a 10-minute wait. And you haven't just slowed down service. You've removed the entire psychological reason the price felt fair in the first place. Here's the part that should genuinely unsettle you. The thing that nearly broke Starbucks wasn't a competitor. It wasn't coffee prices. It was Starbucks' own convenience. The mobile app made ordering effortless. So effortless that order volume outran what a single espresso bar could physically produce during a morning rush. Baristas described drink queues stacking faster than they could pour. Customers standing at the counter, having walked in and paid in person, watched mobile orders cut in front of them, cup after cup. That single design flaw quietly unwound the third-place identity the entire premium price was built on. And while Starbucks was untangling its own bottleneck, a new generation of drive-through-only chains, fast, cheap, no seating, no lingering, expanded aggressively into exactly the daily caffeine-run occasion Starbucks used to own outright. The bomb wasn't external. It was built into the company's own growth strategy, and it detonated in slow motion across 6 straight quarters of declining sales. There's a second fuse burning alongside it. Years of pushing speed and cutting labor hours to protect margins fed a wave of unionization across company-operated stores, baristas, organizing specifically around staffing, levels, and the chaos mobile orders created on the floor. A company that once sold itself on treating partners better than the industry standard suddenly found its own workforce as a visible, public source of friction, right as it was trying to convince customers the in-store experience was worth the price again. So what does the company do when its own convenience becomes its biggest liability? It reverses course publicly, deliberately. The new CEO closed hundreds of underperforming stores, locations with no realistic path to delivering that in-person experience again. He cut the menu by roughly 30%, specifically to shrink ticket times back down. He reinstated the rule that you need to buy something to sit down or use the bathroom, undoing years of an open-door policy. Self-serve condiment bars came back. Baristas started doodling on cups with Sharpies again, a 2-second gesture, engineered purely to make a mass-produced drink feel personal. Again, and the company is now spending roughly $100,000 per location to renovate about 1,000 U.S. stores, chairs, tables, outlets, warmer lighting, rebuilding, brick by brick. The exact third-place atmosphere the mobile order era had quietly bulldozed. That's not a marketing refresh. That's a multi-hundred-million-dollar admission that the psychology was the product all along, and the company nearly gave it away chasing speed. Early results suggest the bet is paying off. By early 2026, leadership was describing the turnaround as taking hold, with renovated stores outperforming unrenovated ones and the worst of the sales decline starting to ease. But the price of that recovery was steep. Over 1,000 corporate layoffs, hundreds of closed locations, and a new CEO whose total compensation package touched 9 figures. In his first year, a number that landed awkwardly next to a turnaround plan. Literally named after going back to basics. Picture 2 Starbucks locations, side by side conceptually, even if they're 1,000 miles apart. Path 1. The company-operated flagship cafe. Starbucks owns the risk completely. The lease, the labor, the renovation bill, the 6 straight quarters of declining traffic hitting the balance sheet directly. High potential margin when the third-place experience clicks. Brutal exposure when it doesn't. Path 2. The licensed counter inside an airport terminal or a grocery store. Someone else pays the rent. Someone else manages the staff, absorbs the local labor market's headaches, eats the slow Tuesday afternoons. Starbucks collects a royalty on every cup and ships the beans, with almost none of the downside risk that just cost the flagship model 6 quarters of pain. One model bets everything on Starbucks perfecting the experience in-house. The other model outsources that entire bet to someone else and gets paid regardless of whether the experience lands. Guess which one has quietly been the more dependable earner, while the flagship stores were busy reinventing themselves. So, look at that green apron one more time. It was never really a coffee company. It's a company that convinced tens of millions of people to preload, cash into an app and call it convenience. That built its highest margins from money customers gave it and never spent. That figured out how to make a $5 latte feel like a permission slip to occupy a comfortable chair for an afternoon. And then, when it optimized that chair out of existence chasing speed, watched 6 straight quarters prove exactly how much that chair had been worth all along. The coffee gets you in the door. It always did. What actually decides whether Starbucks wins or loses isn't the bean. It's whether you still want to sit down. Next time you tap your phone to pay for a drink you preloaded 3 weeks ago, remember what you actually did. You didn't buy coffee. You made an interest-free loan to a company betting its entire future on convincing you to stay a little longer.